Welcome to this explainer. Okay, today we are tearing into a seriously dense financial document to unpack the initial public offering of JustCo Holdings Limited. If you're looking to bypass all the standard financial jargon and get straight to the actual mechanics of this investment, you're in the right place. We're going to look closely at their business model, their recent financial turnaround, where they're growing, and absolutely crucial, the potential risks hiding deep in the fine print.
Look, we aren't just talking about your average run-of-the-mill cubicle farm here. Founded and headquartered in Singapore, JustCo operates a massive flexible workspace platform across the Asia-Pacific region. These are premium, thoughtfully designed interiors that feel more like hospitality experiences than traditional offices. They are literally providing the physical infrastructure for modern businesses to thrive.
Here's our roadmap for today. We'll start by unpacking the IPO, look at how JustCo makes its money, trace their path to profitability, check out their APAC growth, and finally, weigh those investment risks.
All right, part one, unpacking the JustCo IPO. Let's look at the core numbers. Just over 32 million. That is the exact number of new offering shares hitting the market. And this pool is strategically split up between an international placement for the institutional folks and a Singapore public offer.
Priced at exactly 94 Singapore cents a share, obviously that's your baseline for judging the company's valuation right out of the gate. But, the public offering is really just the tip of the iceberg here. Here's the really crucial part. Alongside those 32 million public shares, you've got major cornerstone investors simultaneously backing the company with over 74 million additional shares. We're talking heavy hitters, asset management firms and huge investment funds putting their capital on the line at that exact same offering price. Plus, there's a 5.3 million share over-allotment option built in just to help stabilize the price after they list.
Moving on to Section 2, how JustCo makes money. Let's look under the hood of this business engine.
To truly get their revenue model, you have to realize they aren't just selling one flavor of office space. They've built a portfolio that addresses a huge spectrum of customer needs, catering to everyone from scrappy digital natives all the way up to massive global giants like Tencent and General Electric. It's a brilliant multi-brand strategy. It lets them capture entirely different price points without watering down their flagship name. You have The Collective at the ultra-luxury end, then the flagship JustCo brand, and recently they launched a brand literally called The Boring Office. I mean, you gotta love the honesty there, right? It's an essentials-focused brand built purely for simplicity and affordability.
Now this is where it gets super interesting. Historically, co-working operators relied heavily on traditional leases, signing long, capital-intensive deals with landlords. But JustCo is actively shifting toward management contracts. By partnering directly with landlords to operate the spaces instead of just renting them, JustCo becomes highly capital efficient. It's a total game changer for their returns on capital.
And the results of this dual operating model? Pretty staggering. By the end of financial year 2025, this strategy translated into almost $151 million in revenue, around 37,500 workstations, 54 centers in 12 cities, and a super impressive 84% occupancy rate across the board.
Which brings us to Section 3, the path to profitability. Let's see how they pulled off this financial turnaround. Well, it wasn't exactly a straight line. Between 2022 and 2023, management had to make some pretty brutal calls. They completely ceased operations in the PRC and Indonesia because those markets were just burning resources with barely any revenue to show for it. They streamlined workflows, they tightened up their leadership, and by cutting that dead weight, they finally hit $3.4 million in positive cash EBITDA in FY 2023. Simply put, their core daily operations stopped bleeding money and started generating real, tangible cash.
Section 4. Growth in the APAC market. So the ship is stabilized. Where are they placing their bets now?
They are absolutely stepping on the gas. Their goal is aggressive, jumping from 50 existing centers right up to 78. They are intensely focused on expanding their total addressable market and grabbing new regional market share.
We're talking confirmed, committed new centers in India, Malaysia, and the Philippines, with Hong Kong coming up in the pipeline. And why these places? Because collectively, these markets represent over 70% of the entire APAC GDP outside of mainland China. They are fishing in some very, very large economic ponds.
So that's the rosy, forward-looking pitch, right? But as objective observers, we can't just swallow the marketing materials whole. We have to ask,
What kinds of legal and financial realities are lurking in the fine print of that prospectus?
Section 5. Weighing the investment risks. Time for a reality check.
Right off the bat, we run into a classic IPO hurdle. The prospectus actually spells it out in black and white. Issuing option shares, award shares, and pre-IPO options, quote, would have a further dilutive effect on investors.
Just to translate that financial jargon into plain English, share dilution just means your piece of the pie shrinks. If executives and early employees exercise their pre-existing options, millions of new shares just pop into existence. The company isn't magically worth more. The pie's just sliced into way more pieces. If that happens, your ownership percentage automatically goes down.
Then there's this really complex accounting wildcard involving the incremental borrowing rate, or IBR. Because JustCo manages a mountain of real estate, how they calculate those lease liabilities on their balance sheet is absolutely critical. The prospectus openly admits that estimating the IBR requires highly subjective adjustments. It depends on the specific entity, the country, the currency, the asset type. If their estimates are even slightly off, they could theoretically owe a whole lot more on those leases than it currently looks like on paper.
And you simply can't ignore the broader macro environment. The risk profile here is thick. You've got credit risk, the very real threat that in a bad economy, their corporate members just go belly up and default. You have massive foreign exchange risk. Operating in 12 different cities means a 10% swing in local currencies against the US dollar hits their bottom line directly. And finally, goodwill valuation risk. If the cost of funding their business shifts, the theoretical value of the assets they've acquired could plunge.
So we're left with a truly fascinating corporate narrative. JustCo practically performed surgery on its own business to stop the bleeding, cut the deadweight, and build an impressive 84% occupancy rate across multiple brands. But they're navigating a highly volatile multi-currency market with heavy lease liabilities and the shadow of share dilution hanging over them. So I want to leave you with this to chew on. Is JustCo's clever pivot to capital-efficient management contracts actually enough to sustain their turnaround against those complex macroeconomic headwinds? Think about it. Thanks for joining me on this explainer, and until next time, keep looking past the headlines and straight into the fine print.